Hello, everyone. This is Jeff Foley with Paladin Financial, and thank you for tuning in to this week's episode of Paladin Financial Talk with me, Matt Bryant, advisor with Paladin Financial. Thank you for joining us, Matt.
Hello. Good to be here.
Well, hello. So we're going to continue this week our episodes on the One Big Beautiful Bill that passed on July 4th. Last week, we gave kind of a high-level overview of the bill, and today we're going to dig into some additional fine details of that and talk about some of the nuances that people want to be aware of and that you can use to start planning over the next few years how you could take advantage of what this has put into place. So today we're going to talk about the SALT cap, alternative minimum tax, and then some special tax breaks that might surprise you. So to kick us off first, Matt, you want to talk about our first one?
SALT deduction cap increase. So this is the state and local tax deduction. So think back to the Tax Cut and Jobs Act of 2017. This was implemented during that time as a way to cap the amount of deductions against your federal return as far as your state income and then any local taxes like property taxes that you may pay. So they set the cap way back then at $10,000, which really hurt those folks in higher income tax states. Think California, New York, New Jersey. Minnesota, though, is also a state with
up there.
a higher income tax. So $10,000, many people, many working folks especially, were capped out, and so they lost out on some deductions as far as income taxes go. So with the recent passage, that actually increased from $10,000 to $40,000. So a pretty significant increase. Now it phases out, so a couple earning more than $500,000 starts to lose the benefit, but that's still a healthy amount of income before you actually hit that cap. It also increases 1% per year through the year 2029, and then starting in 2030, it reverts back to that $10,000 level. So that's important for a lot of us and our clients here in the state of Minnesota. Property taxes, they're close to on par with the country here in Minnesota, but home values are rising, so your taxes are rising as well. So that's going to be important for a lot of folks as they do taxes compared to most recent years. They're going to likely see a bigger benefit. The one key part of this, though, is you have to itemize when you do your taxes to be able to use it.
Yeah.
So, AMT may still limit this benefit, which let's just go ahead and take us into the AMT.
One more thing too, before AMT is some states, I think maybe a dozen or so states allow, if it's done properly, a business could potentially take over some of those state and local taxes and that be a deduction, but you want to make sure to check with your CPA. Right. Depends on your situation, how your business is structured, but that's a possibility to explore. But yeah, AMT is one of the most confusing aspects of the tax code. I would call it a higher of the two. So you're calculating your taxes two different ways, and you're going to pay the higher of the two. So AMT was created back in 1969 as a way to prevent high income earners from, you hear about the super rich people that don't pay anything in taxes. AMT was created to help limit that, to reduce some of those loopholes, if you will. So taxpayers who might be subject to AMT calculate their tax liability under both the regular tax rules and the AMT rules, and then pay the higher amount. So the AMT calculation involves adding back certain deductions and what are called preference items in order to recalculate under the AMT rules what the tax bill is that you should pay. So you adjust your regular taxable income with those items, and then you apply the AMT tax rate, which is either 26 or 28%, and compare that to your regular income tax liability. So some common items that get added back into the AMT side of the equation: state and local tax deductions, Matt, as you alluded to, miscellaneous itemized deductions. So for example, ones that are subject to the 2% floor, such as unreimbursed employee business expenses, home mortgage interest, only interest on debt that's used to acquire, construct, or substantially improve a residence, a main or second home, can be deducted, but things like interest on home equity lines of credit used for other things like a car or debt consolidation, that does not count. That's not deductible for AMT. Some other ones, less common: interest from private activity bonds, the bargain element of incentive stock options would be another component. Depreciation, depending on how that's calculated, talk to your CPA about that. That's less common for a lot of people. Another rare one is net operating losses if you're a business owner. So with the one big beautiful bill, the Tax Cut and Jog Act's higher AMT exemptions, it's so difficult to say.
Yes.
They are retained. So 88,100 for single, 137,000 for married. So in other words, once you calculate your AMT income, that's saying we're exempting the first 88,100 of income under that formula, and then it gets phased out as your income increases. So that phase out starts at $500,000 if you're a single taxpayer, $1 million for married filing jointly, and then you get fully phased out at about $626,000 as single and about 1.3 million for joint. So if you have a big income year between now and 2029, which is when this goes away, consider timing that income to take advantage of that window. So if you have the ability to adjust your income and deductions to kind of plan ahead for that. So that's where if you have a good CPA, you can do some what ifs to plan ahead for these things.
Yeah, and you threw out a lot of acronyms and a lot of different numbers, and that's our tax code. It's confusing, and when they try to fix one problem, other loopholes might open up. But just knowing your situation and having the experts in your corner to talk to can save you a lot of money.
Yeah, definitely.
All right, so moving on. This was a big campaign promise during the most recent election: is tips and the income deduction that you can get for the tips that you earn. So the big change is that up to $25,000 of qualified tip income is now deductible, and that starts to phase out at $150,000 for a single filer, $300,000 of adjusted gross income for married filing jointly. So think servers, barbers, rideshare drivers, anyone who has a large tip component to their livelihood could see their taxable income decrease. Now you can make your jokes about how much of cash tips get reported, but a lot of transactions are done with credit cards and such now. So those tips are being counted. You want to keep meticulous records, right? Because this is probably one that's going to be pretty heavily scrutinized by the IRS. So that's a lot of potentially a good portion of people's income that's now much more favorable.
Yeah, think of how many more places you go to nowadays where they turn the screen around towards you or they hand you the device and act like they're looking away while you make a decision on what tip you're going to get. So I'm sure the tip income has increased, I would assume, quite a bit since that
absolutely
was introduced to us. So thank you, COVID.
Yes. Yeah. And it's just, it's a different world now. And for a lot of folks, that's going to be a pretty significant amount of savings. So, leading into another one that could be a benefit for a lot of folks, auto loan interest deduction. What does that mean, and what are the parameters there? Yeah, so if this qualifies, the idea is you can deduct up to $10,000 a year of interest paid on a new car that was, provided the vehicle was quote unquote built in the United States. So if you're a brand new vehicle only, not used, any dealership that you work with would be able to tell you whether or not that car qualifies for it, because it can get very complicated. You know, parts were made in Mexico and China and assembled here and assembled there. So there are rules they have to follow with that. But the eligibility for that phases out if your income is above $100,000 for individuals, $200,000 for married filing jointly, and then it's phased out once you get to $150,000 of modified adjusted gross income as an individual, and $250,000 for married filing jointly. And this one only runs through the end of 2028. So that's why any new tax law change that comes about, you want to look at when are the deadlines, you know, how long do you have to take advantage of this? We're talking about some of these end in 2029, 2028, and so on. Some start in 25, some start in 2026. So the auto loan interest deduction is now through the end of 2028. So you want to be aware of the timing on that. And that's, you know, obviously part of that's to try to bring manufacturing, focus it more in the United States. I haven't seen any commercials yet. I don't know if dealerships would ever go that far to say, hey, look at this deduction. A lot of people probably don't know about it. If you are in the market, it is something that could save you. You might as well take advantage of it.
Yeah, I don't usually watch live TV, but I'm sure they're peppering us with commercials about that. So that's an important one. What about no tax on overtime, Matt?
Yes. So another campaign pledge from the most recent election. So this means there's no tax on overtime hours worked. So this is 2025 through 2028. The deduction is capped at $12,500 per person or $25,000 per couple. Again, phases out at the $150,000 level of income for a single person, $300,000 if you are married filing jointly. So think occupations where there is a lot of overtime, maybe law enforcement officers, the trades, manufacturing again. So depending on seasonality is a big part of it too. You might see certain industries or sectors have greater amounts of overtime hours, whether required or offered. So most oftentimes you get a benefit, higher pay for those hours, but now that you get a tax break on top of it, that could be pretty lucrative for those people in those industries. So that's been a good one to see.
Yeah, almost like time and a half.
Yeah, there you go. All right, this is another big one, the child tax credit increase for 2026.
Yeah, so that increased by $200. And so the child tax credit, $2,200 per qualifying child. Your income limits on that, modified adjusted gross income, $200,000 for single filers and $400,000 for married filing jointly. And then it phases out, obviously, beyond that. Phases out completely if you get to $240,000 of income for single filers and $440,000 for joint filers. And again, with any of these provisions that have income limits, we've talked about this in the last show, is know what type of income they're talking about. So there's your taxable income, adjusted gross income, modified adjusted gross income. Make sure you're aware of what number is being used with that. So a lot of moving parts with that. So yeah, there's a few planning ideas for people to consider depending on your situation and what moving parts you have over the next few years to take advantage of these tax law changes. So as we talked about last night, some action items. Look at your multi-year tax plan. Don't let just things happen to you. Plan ahead as much as you can. So is there income coming in or deductions that you can either pull forward or push back a little bit in order to help you to optimize these moving parts? Make sure that you touch base with your CPA and they know about these changes and how they relate to you. Start talking about that so it's not 1 year too late. And if you're near income thresholds, there also might be some planning opportunities where you can reduce your taxable income, maybe by increasing contributions to your retirement plan at work or a traditional IRA in order to get under that wire for your adjusted gross income and whatever limit is being utilized there. So think ahead, plan ahead with that, and make sure you save, don't leave a tip to the IRS as much as possible. As always, folks, if you would, please take a moment to rate us on whatever podcast app that you're using. We would really appreciate that. It gives the show an opportunity to get exposed to more people that might benefit from some of the ideas that we share on the show. And if you have any questions that you want us to review, send us an email at info@paladinfinancial.com. Or give us a call, 651-842-8406. You can visit us online at paladinfinancial.com. And next episode, we're going to shift the focus to talk about some long-term planning, estate taxes, charitable giving, a little bit about the Trump accounts, and a few other items. So thank you, Matt, for joining us. And thank you, folks, for tuning in. Have a great week.